90% of traders lose money. And no, it's not because the market is hard. People lose money because they trade without a plan. They enter trades because of emotion, not logic. Fear makes them close too early. Greed makes them hold too long. Most beginners want fast money. They overtrade, overrisk, and ignore rules. One bad trade becomes revenge trading, and one loss turns into a blown account. The market is not your enemy. Your mindset is. Successful traders think in probabilities. They accept losses and protect their capital. They focus on discipline, not excitement. If you want to survive trading, control your emotions, follow your plan, and remember, trading is a marathon, not a lottery. In this video, I'm going to show you how to read market structure and spot supply and demand zones in the market. Understanding market structure is the first step to becoming a smart trader. It shows you where the market is trending, where it's likely to reverse, and where the smart money is hiding. A supply zone is an area where sellers are strong. When the price reaches a supply zone, it often goes down. A demand zone is an area where buyers are strong. When the price reaches a demand zone, it often goes up. By spotting these zones, you can find better entry points and reduce risk. The key is to wait for confirmation and follow the trend. Looking at this chart, you can see the market is moving up, creating higher highs and higher lows. This is what we call a bullish market structure, which means our goal is to look for buying opportunities. The best place to enter a trade is near a demand zone, where buyers are strong. Sometimes, price will make a liquidity sweep, touching a previous low to grab stop orders before moving up again. This area is often perfect for entering a buy trade with low risk because it gives us a better chance that the market will continue higher. The key is to wait for confirmation at these levels. We don't just enter anywhere. We look for price to react to the demand zone or liquidity sweep before buying. By combining market structure, demand zones, and liquidity concepts, we can trade smarter, follow the trend, and reduce unnecessary risk. Please look at this entry. Here, we get a change of character after sweeping. It is a sign that a big player has been wiped out all the retail trader out of the market. Right after that, price makes a strong bullish move, which tells us institutions are entering the market. Before this move, price forms a small base. This is our demand zone. Instead of chasing the move, we wait for price to pull back into the demand zone. This is where we enter the buy. The stop loss is placed below the demand zone, because if price breaks this area, our setup is invalid. The take profit is set at the previous high, where liquidity is resting. This gives us a clean 3-to-1 risk to reward trade. No indicators, no guessing, just structure, demand, and patience. Here is another example. This is not a break of structure yet. For a structure break to be valid, we must see a full candle body close beyond the level. A wick alone is not enough, because price can still be rejected. Only when the candle closes with its body above the structure do we consider it a real and confirmed structure break. This confirmation helps us avoid fake breakouts and protects us from entering too early. This is a valid structure break because we already have a full candle body close beyond the previous structure level. This is important because a real break of structure is confirmed by the close, not just by a wick. Once the body closes above the level, it tells us that buyers have taken control and price has accepted higher prices. At this point, the previous structure is no longer respected, and we can confidently say the market has shifted direction. Please look at this. Price failed to break structure here. Even though we see a wick pushing below the level, the candle body did not close below structure. This tells us that sellers were not strong enough to hold price lower. Instead, this wick is a liquidity sweep. Price briefly moves lower the level to grab stop losses and resting orders, then quickly gets rejected. This is a common smart money behavior. where institutions take liquidity before moving price in the real direction. Because there is no body close, the structure remains intact, and we should avoid entering too early. Here, price creates a change of character. This tells us that the market has already grabbed liquidity from the previous move. Sellers are no longer in control, and buying pressure is starting to step in. After liquidity is taken, the market no longer needs to move lower, and this is often the first sign that price is ready to shift direction and move upward. This change of character signals a potential transition from bearish to bullish conditions, and it prepares us to look for buy opportunities, not sells. Here is another example that is very similar to the previous trade. Price attempted to break structure, but it failed to do so. We only see a weak break with a wick, not a confirmed body close. This tells us that the market was sweeping liquidity, not actually breaking structure. After that, when we drop down to the lower time frame, we can see that the order flow is clearly bullish, with buyers stepping in and defending price. With higher time frame structure still intact and lower time frame order flow aligned to the upside, we now start looking for buy opportunities. Our target is set around the previous swing high, where liquidity is resting. Now, I'm going to show you the last example. First, we start by identifying the overall market structure. And as you can see clearly, price is bearish, with lower highs and lower lows. Since the structure is bearish, our focus is not on buying. Instead, what we need to do is mark the supply zone at the previous swing high, where sellers previously stepped in strongly. After drawing the supply zone, we don't chase price. We simply wait patiently for price to return and mitigate this zone. Once price come back into supply, this is where we look for sale opportunities, following the direction of the market. Here is a liquidity to target. Please like and subscribe if you find this video very helpful. Bye bye, see you in the next video.